All right, guys, welcome. It's Sunday, July 4th. My name is Dave Coker, and this is Talking About Finance. You know the routine by now, 7 slides for 7 days, although today we got another 8 slides. Just talk to my friends too much about money, okay? Here's what we're chatting about, me and my buddies. And remember, this all comes from instant messages on Telegram, as well as Discord that we tend to bounce around and email, and just things we find interesting about finance. This is a really good one. This is showing, my friend, now I think she put this on Twitter as well, but this is showing that when you look at some food that they got in New York, I believe it was, you can see the label there, pears grown in Argentina, packed in Thailand. And one of my buddies went in and did this map, and that's his word, wasted. I don't really agree with that totally, but it's really interesting, guys. When you look at this, look at how far apart those two nations are. Now, there's a couple things going on here. One that I wonder about is in the new realm of ESG, how is this going to manifest? How is it going to persist? It's not really cost effective from an environmental point of view, I think, to grow some pears in South and Central America and then ship them. Admittedly, they grow, I looked into it, they're going by surface transport, so they're going on ships. I don't know how long it takes, it's not the point, but they ship the pears over to Thailand, they're packed in Thailand, and then they're shipped to the United States. That's a lot of travel. It's roughly 3/4 of the way around the globe just to get the product from there to consumers in the States. So that's the first one. How will this last in the new era of ESG? And then second, this just shows really that the West is on borrowed time. They're taking advantage, or the lifestyles that they've got in the States, they're taking advantage of this extra cheap labor in different nations. It probably won't end well over a longer period of time as these nations industrialize and they lose the cheaper labor, the price of labor goes up. But it's interesting to think about there. So that's a fascinating one. That also makes me think about the money and thinking about how long can the West manifest or maintain this type of labor arbitrage. It's really interesting. Now, the Danish central bank came out with a report over the weekend, I think it was. It must have been because I just got it yesterday. That showed in the EU, it showed the 5 richest and 5 poorest nations, and this is fascinating because, of course, you know, Denmark, Netherlands, Sweden, Luxembourg. You'd sort of expect them to be up there, and then down at the bottom you've got the Eastern European nations. And guys, just because they're relatively poor compared to the other European nations doesn't mean lifestyle's bad down there. Remember, it's just cheaper to live in those nations. So the people do live well. And my God, we've got Eastern European food stores in our neighborhood. Holy cow, the food is awesome. I tend to buy an awful lot of stuff at these Eastern European, Russian, and other stores like that. But the thing that was really cool, guys, was where's Germany? Yeah, that's a fascinating one. I did download the original report, and it kind of looks like Germany. They're just not that, they don't really have money like we would have, or like say like the Danes or the Dutch do, or even we would have in the States. But however, Germany, they're not hurting. I lived over there for a while when I was with Deutsche Bank, and very good lifestyle. The state just takes care of everything. So people typically don't accumulate a lot of money themselves. It's very rare, actually, for people to have exceptional wealth there. And this is a really good one. Now, this came out Friday, and you really would think FT would know better because they ran this article, and my God, it's just the most amazing thing. And poor Bernanke, they dredged this quote out from over 10 years ago. And I remember when he said it at the time, it was sort of eyebrow raising. But now they're bringing it out again in the context of cryptocurrencies, namely FT doesn't like them. And they're saying that you can't really call it fiat money. What they are suggesting you call it instead is credit money. I don't know about that. Of course, we know, our study of our finance tells us that fiat is from the Latin word for faith, and it means we believe, and that's really what gives the value of the dollar, because we believe it's worth $1. It'll buy a dollar's worth of goods and services. And they were trotting this out and trying to attack crypto, and it's bizarre because crypto, why is crypto worth, it's worth about 35,000 this morning. Why is it worth 35,000? Because we believe it's worth 35,000. And then again, you know, I'm very active in that space, and once again buying Bitcoin after about an 18-month hiatus. And guys, I'm not selling any Bitcoin because I do believe in the future the value of Bitcoin will be higher, perhaps much higher than where it is now. Because when we talked about this last week, you can just go back and look, because we know about 18.9 million of the 21 million Bitcoins that will ever be mined have already been mined. And if you ain't gotten them, you may want them in the future. So, but it's really interesting that FT is starting to bang the drum against cryptocurrencies. We'll pay attention to that because the Western democracies are starting to realize they've got a problem. And we are busily carving out an entire financial system based upon blockchain and technology, and we just don't need these guys anymore. It's really fascinating. Now, in terms of investing, when we're talking about money, this was really good. One of my friends pushed this over. And check out these IPOs that have negative earnings. The top chart's the really good one, right? You can see that roughly 80% of IPOs that are coming to market now have negative earnings. I was reading an article this morning about Robinhood. Robinhood's got extreme losses. I think it's up to 1.4 billion in the most recent quarter, which is very amazing. But aside from that, who's going to buy that darn stock? Well, we know people will be buying that stock, and they're actually planning to farm out 35% of the IPO to retail investors who they suggest would normally be locked out of IPOs. Well, I think it's for a good reason that retail is locked out of an IPO. Sometimes they just don't have the skills to properly analyze stocks and understand exactly what's going on, but Robinhood's going to be pushing it out. It's really wild that you can see that so many IPOs have negative earnings. And it turns out, guys, that we're in this bubble, I'm calling it, for equity issuance. Now, we've got at the top here, we've got equity issuance over the past 30 years. And you can see we're at a record level. We're much, much higher than we were going into the dot-com collapse or even the global financial crisis. And at the bottom, we've got both IPOs and SEOs, which is seasoned equity offerings, in other words, secondaries. And it's wild. So why are companies taking advantage of these markets to raise so much money? Because the markets are incredibly overvalued. Companies know this. They're raising a bunch of capital now, and they'll just let it sit in the bank or let it do something else with it. They really don't need it to expand their business. So when you're offered the chance to participate in an IPO, or even when you buy any stock, really what you want to do, guys, is just make sure the numbers make sense. In other words, don't look back. And this is a good one. This is mine, of course. You can always tell my style. And this is something I always tell people. You know, when Buffett went into Apple way back in 2016, the stock was already up well over 7,000% from its IPO, but he piled into it. Why did he buy it? He bought it because he thought the future performance was much, much better. In other words, its best days were yet to come. Warren was absolutely correct here. Look at that. My God, that return's absolutely amazing. And he moved in initially relatively small holding, 10 million shares, for him at least. For us, it would be eye-popping, most of our net worth, right? But he bought 10 million shares, and then over the next 4 years, he continued to buy. And now he's holding, I'm not aware of him doing any sales, but he's roughly 245 million shares. And you can do the math and kind of figure out what he did. It's really amazing, the returns that he generated on that position. Oh, and you know, we got to talk about Bitcoin. We just have to. Again, right? But it's interesting because the Chinese, of course, have shut down a lot of miners. Now, Bitcoin, in case you're not familiar with the tech, every 10 minutes, Bitcoin is created. It's created as an end result of a process called mining. And mining simply means that miners use technology, use special purpose computers, ASICs they're called, to solve a complex mathematical problem. And periodically, the difficulty factor of the problem is adjusted. It's either increased or decreased such that the rate of production of Bitcoin will remain stable every 10 minutes, in other words. So they don't let it get too easy so that the rate of Bitcoin issuance accelerates. They don't let it get too difficult so the rate of Bitcoin issuance drops. The network manages itself. And we've seen on the right-hand side, you can see the difficulty adjustment was 28%. It's a record high. We've never seen an adjustment of that level before. It's absolutely incredible. And we'll see what happens with the impact of Bitcoin over time, the price of Bitcoin over time. And finally, guys, I would like to offer you an invitation to join us. I'm pretty upfront about the way I live. I have no debt. I invest for long term. I've got shares I've owned over 20 years ago. I've got property I've owned over 20 years. Delayed gratification. Dudes, guys, listen to me. I got 2 pairs of trousers. One for work, one for play. That's it. I don't really need to have a lot of clothes that just sit in the closet gathering dust or that I'm never doing anything with. When I invest, yeah, I'm very patient. I do experience losses, unrealized capital losses. I don't care. If I believed in the stock, if I liked the numbers, when it goes down, I just buy more. That's all I do. Is it painful? Yeah, I don't know, not really. I mean, I'm so used to it by now. But you might find it a little painful or distressing to watch the value of your portfolio, the value of your positions to go down. Just wait for the market to catch up. In other words, delay your gratification, invest heavily as much as you can, sacrifice. And if you do that, you'll achieve financial independence, guys. And we've talked about it briefly in these, and I've got my wealth class. If you're interested, PM me, and we could talk about that. It is possible just by investing in dividend-producing assets, stocks, REITs, for instance, high-yield ETFs that generate very high income, monthly income, investing in corporate bonds and vehicles like that, you can achieve financial independence, guys. You can do this. It just takes time. And it'll take about 10 years. So join us. There's your recipe right there. And you can look this guy up on Twitter. There was a good thread there. I didn't subscribe to this guy, or didn't follow this guy, I should say. But after one of my friends, when she mailed it to me and said, look at this guy talks like you. And I was like, oh, okay. He's a solid dude. All right, guys, that's it for this week. Once again, to Americans out there, happy 4th of July. I haven't been back in the country since 2008, so I don't celebrate. Oh, I've been living abroad since 97, so I don't celebrate, but I hope you have a good time there. Watch out for the fireworks, drink beer, eat hot dogs, have a good time. Take care.